I'd like to introduce our second round table, which is focusing on green finance for you this afternoon. What is green finance? Well, it's ultimately essentially a loan or investment that looks at environmentally positive activities, so how investment can be done in a green way, ultimately. The question that we're going to be asking today is green finance regulation the way forward, and does it actually add value to business? And of course, this fight mobilizing people against climate change. Before I introduce our panelists who will be up here with me today, I just want to remind you again about the interactivity of this event. You saw that it worked really well in the first half. If you do have a question, and I know a couple of people grabbed me outside and said, look, I'd like to ask this. I directed them back to the QR code, okay? As long as you put your questions in, they're filtered through to us, and you have a real chance of our IP Paris students coming up here to get those questions to our panel. So it is working well for this interactive conference today, our second international conference called Reflections on Climate Change 2023. To get things started, I would like to welcome to the stage Jo Tyndall. She's Director for the Environment Directorate at the OECD. Jo will be fleshing out some ideas for us about the urgency to act when it comes to climate change. She'll also be specifically outlining the OECD's approach when it comes to mobilizing finance for climate. So Jo, if you'd like to join me up here, I shall let you take things away. Thanks very much, Jo.
Well, good afternoon, bon après-midi à tous et merci de m'avoir invité à parler sur ce sujet très, très important. I will speak in English, but I understand you have translation. And I now have a PowerPoint presentation, which is great. It is my pleasure to speak to you today on one of, if not the, most critical enablers for reaching the goals of the Paris Agreement, and that is delivering finance for climate action. Now, this is finance at all levels. It's domestically, it's internationally, and the multiple vehicles of delivery, whether it's public finance, multilateral development banks, central banks, other financial institutions, right to the level of the private sector. So it's a massive subject. We are at a serious crossroads when it comes to bridging the finance and investment gap and ensuring we meet global net zero emissions by 2050. And as I'm sure you're all aware, failing to deliver on this objective truly risks failing our planet. Before I speak about what we're doing at the OECD to drive this agenda forward, it's important to take a step back and remember that first and foremost, we do have the legal framing in the form of the Paris Agreement for work on climate change. And that is a very powerful political statement of intent that sets temperature goals that are underpinned by nationally determined contributions, by a ratchet mechanism for ambition, and by transparency, as well as, of course, financial goals, which I will touch on today. Now, each successive year, IPCC reporting confirms that the problems are worse than we thought, and that climate change is moving faster than we had thought. So governments now have to do everything possible to limit a global temperature overshoot beyond 1.5 degrees Celsius. And that means reducing emissions quickly. Now, this graph is important. It relates to the most up-to-date evidence on climate system tipping points. And it shows that we are already entering the warming range at which potentially catastrophic impacts become possible. So the massive and rapid scaling of finance from all sources is the critical lever to safeguarding our planet and to staying the course for net zero. It really matters that we limit both the extent in terms of degrees Celsius and the time frame for any overshoot of 1.5 degrees. You can see if you do more, we are going to face more of these tipping points. The first port of call, of course, is mitigation, to kind of stop the fire at its source, if you like. And finance has to be directed to that. But we've already reached a point where there's a certain amount of baked-in global warming with CO2 in the atmosphere that is going to force us to spend money on adaptation as well. Now, despite what this slide is telling us, there is at least some good news. There is enough money in the system to make this happen. It's just that a lot of it is misdirected. And what's needed is the activation to their fullest potential of all enablers for driving finance into investment, projects, and activities that are going to make sure we can transition to net zero emissions and build our resilience to the impacts of climate change. So this slide indicates there are two broad building blocks to make this happen. First, we track and measure climate finance. That is the flows of finance provided and mobilised by developed countries for developing countries in support of the $100 billion goal. Second is the efficient operation of the mainstream financial sector. That means shifting financial market practices so they're working effectively to allocate capital in ways that are in alignment with the Paris Agreement. So digging a little bit deeper into the first building block on climate finance, at the request of donor countries, the OECD has been measuring progress towards what is a politically really important goal of $100 billion annually being provided in climate finance. We've been doing that since 2015. So just as a reminder, at COP15 back in 2009, developed countries committed to a collective goal of providing and mobilising $100 billion per year by 2020 to support climate action in developing countries. And this was reaffirmed and indeed strengthened at the Paris COP in 2015. Our tracking helps drive accountability amongst developing country governments on this commitment, and it shines a really important spotlight on current levels of global public finance, including the levels of mobilised private finance. Our most recent report that's reflected on this graph indicates that in 2020, and remember this was the initial target year for that $100 billion goal to be met, in 2020, total climate finance provided and mobilised by developed countries reached $83.3 billion. So that meant it fell short of the goal by $16.7 billion. In addition, the private climate finance mobilisation we can track has stagnated since 2017 and actually declined in 2020. So there's a clear gap that donors need to address. And with the developing world suffering the brunt of the impacts of climate change and calling for much needed support in mitigating emissions, there really is no time to waste. So mobilising private sector finance is critical to this. And when it comes to the levels of finance needed to achieve the global transition to net zero emissions by mid-century, we can't get there otherwise. The energy sector is going to require, and this is just the energy sector, is going to require an annual investment of $4 trillion in clean energy by 2030, less than 7 years away. Public finance alone can only ever be a drop in the bucket towards that, So it won't be enough to get us across the line, but it can be a catalyst, and it's important it's used in the right way. There is considerable scope to use public climate finance much more effectively to support the conditions for private investment. Many green technologies, particularly clean energy technologies, are already commercially viable, and the International Energy Agency has produced reports that indicate solar energy, for example, for the first time, is the cheapest form of energy, even cheaper than fossil fuels. The remaining hurdles to investment can often be overcome with limited intervention from the public sector by providing the right policy environments and just enough public finance to de-risk investments. So this is all about crowding in rather than crowding out private investment. Our analysis shows that blended finance, by which we mean the strategic use of development finance to crowd in commercial and other finance, that blended finance can play an important role. However, it needs to be scaled up and deployed more effectively to target the underlying barriers to investment, of which there are quite a number. Now, we also need to rethink the role of donors and multilateral development banks. The MDBs have been highlighting the need for increased resources. They want more money from their shareholders to more effectively mobilise private finance. While donors, on the other hand, are stressing that existing resources can and should be used much more effectively. Well, there is validity in both arguments. More public resources are certainly needed, but the current deployment of resources is not optimising private capital mobilisation. And these are the areas where the OECD is providing support and analysis. We're currently preparing, at the request of donors, detailed analysis on mobilising private finance. And this focused analysis is going to be ready for release in the lead up to COP28 at the end of this year. You can see the key areas we plan to cover in supporting mobilisation here on this slide. Yes, I'm hoping I'm on the right slide there. And we'll come back to this later. So, shifting global financial markets, moving to the second building block, it goes without saying that the net zero transition requires a whole of financial system response. We can't deliver on finance for climate change without shifting the broader mainstream financial sector from grey to green, if you like, and ensuring efficient market practices are driving climate-aligned finance flows. And that would unlock an entirely new order of magnitude in the scale of finance going towards climate action. Here, the OECD's work includes analysing the alignment of investment approaches with climate objectives and, in particular, ESG reporting. Well, it's a relatively new concept. It's been rather stakeholder-driven to date, but that is changing. I have included some of the outcomes of this analysis on the slide here, which is quite a complex one to have a look at. But just to note that our work has raised questions as to the usefulness of these ratings for investors, particularly when it comes to the environmental pillar, or the E of ESG. For example, high scores in the environment pillar of ESG ratings are not always correlated with lower levels of greenhouse gas emissions. The intentions are not being matched by the outcomes, and sometimes the planning isn't even there. Now, the OECD has provided policy guidance to support governments strengthen ESG investing and climate transition practices. And what we've therefore focused on, given these problems, is developing high-quality disclosures, metrics ratings, targets, and frameworks. The OECD recommendations on ESG focus on improving the transparency and credibility of ESG rating methodologies and promoting market integrity. Really important concepts there. They encourage global comparability and quality of ESG metrics and approaches, for example, through mandatory disclosure, and that is starting to happen for a number of governments. Importantly, the guidance calls for a science-based, calls for science-based interim net zero targets to ensure that transition plans and supporting material are robust. Credibility is absolutely essential for the effective allocation of much-needed capital in support of climate action and the effective operation of markets as a whole if we are to achieve a sustainable and truly resilient transition to net zero. So, effective allocation of capital in support of climate action has to extend to aligned action at the firm level, at the business level. And that means activities in support of reducing emissions and building resilience to climate impacts. For this, the OECD has developed two important legal instruments to drive this forward, both of which have recently been revised to strengthen climate-related commitments. First, on the slide there, the OECD guidelines for multinational enterprises on responsible business conduct. This is the only multilaterally agreed and comprehensive instrument on RBC that governments have committed to promoting. The 2011 version has been revised and was formally adopted just this week, approved at the Ministerial Council meeting held at the OECD. It now includes clear expectations for business on action related to climate and biodiversity loss, and specific recommendations for business in conducting due diligence on a range of environmental risks and impacts. These expectations relate not only to the direct operations of a business, but also activities across the supply chain. So in other words, it extends to the so-called Scope 3 activities or emissions. The guidelines are already being well reflected into law, for example, through taxonomies, due diligence legislation, and regulations for disclosure. The second example, the G20 OECD Principles of Corporate Governance are an important international standard for policymakers in evaluating and improving the legal, regulatory and institutional framework for corporate governance. And these principles have also recently been updated to include a new dedicated chapter on sustainability measures. Now, it's a well-known adage that we cannot manage what we can't measure. It's an adage that has the advantage of being true. And shifting the focus of the mainstream mainstream financial sector to alignment with the Paris goals on mitigation and resilience will not be possible without measuring and tracking. And this is the commitment reflected in Article 2.1c of the Paris Agreement. Investors and financial institutions are increasingly committing to Paris Agreement alignments. Paris Agreement alignment, what does this mean? Many of the metrics and underlying methods being used to give effect to commitments lack consistency, and they provide little evidence of any real economy impacts. In fact, our analysis shows that at best, current efforts are leading to little or no decarbonisation in the real economy, and at worst, are giving both markets and policymakers a false impression of progress, so having what's known as a greenwashing effect. To be sure, we make real progress in mobilising finance for climate, and in a way that leads to real impact at the firm level. Improved and consistent metrics and methods for measuring alignment are essential. So the focus on environmental integrity or credibility, particularly when it comes to greenwashing, is a key pillar of our work in transition finance. And by transition finance, we mean finance to support companies, particularly those that are operating in hard-to-abate sectors, in moving to net zero emissions. Concrete, steel, a couple of examples. Now, this concept of transition finance is gaining traction, leading to a proliferation of diverse transition finance initiatives by both government and industry. However, for transition finance approaches and related financial instruments to be robust, they must be based on credible transition plans. And this is central to the focus of our guidance on transition finance. And that provides 10 key elements for credible corporate transition plans, highlights areas where more transparency is needed. And those 10 elements are listed on this slide. Now, before I conclude, I just want to make one final point. I touched on efficient and well-functioning markets as necessary for enabling aligned climate finance flows. But it is important to remember they will only be able to function in this way if we all work within our planetary boundaries. Climate change and biodiversity loss, it's increasingly evident, are two sides of the same coin. You cannot implement durable and robust solutions for one without taking on board the other. And with biodiversity and ecosystem services underpinning all economic activities and human well-being, the destruction of biodiversity at an unprecedented rate, which we're experiencing at the moment, is posing significant risks to both the economy and the financial sector. And despite this, biodiversity-related financial risks, dependencies, and impacts are systematically mispriced by the financial sector, and that's going to have to change. And addressing this challenge, the OECD is developing a methodological framework to help central banks and retail banks assess biodiversity-related financial risks. Now, this includes a recent OECD report referenced there, mapping existing approaches for assessing biodiversity-related financial risks, impacts, and dependencies. And we will be working to follow up on the finance goals that were reflected in the Kunming Montreal Global Framework that was agreed at COP, the Biodiversity COP15 last year. And I should note, incidentally, that of course for climate and biodiversity, we're talking about the same pool of money. There's not a sort of a different approach. So we have to work in ways that have synergy and are well coordinated. So looking ahead, in closing, I would like to remind us all of the importance of being positive, of focusing on the opportunities. In the beginning of my speech, I highlighted that there is enough money in the system to bridge the critical climate investment gap. To make sure the money goes to where it needs to go, our work centres around the two key building blocks I've discussed today: the need for tracking progress on climate finance, their flows, and the need to shift global financial markets to enable the efficient allocation of capital that is aligned with climate objectives. And all these efforts have a critical focus on mobilising private sector finance. I realise that none of what I've mentioned is going to be simple or easy to implement, and this runs counter unfortunately, to the pace of change that the climate crisis demands. But what I do want to assure you is that there is progress. And there is progress across all of the areas for action I've shared with you. Not only is there progress, but these building blocks represent core priorities for our work right across the OECD. There's internal collaboration, whether we're talking about tax, economic department, development cooperation, financial affairs, directorate, etc., etc. We're looking at it in a holistic way from a whole range of different perspectives. And what's more, we are only going to see further opportunities to capitalise on these efforts. I've just put a timeline on this slide to show a few of the big political moments coming up with, for example, the next one. Well, I'm going to Bonn this afternoon for a brief visit during this annual meeting. And the next one later this month is the Climate Finance Summit being held here in Paris. I will mention COP28 as just one example, though. 3 of the main negotiating targets for COP this year are finance-related. First, the negotiation of a new collective quantified goal for climate finance as a follow-on from the 2020 $100 billion goal. Here, negotiators are going to be discussing both a target amount and where the money is going to come from. Second, the Loss and Damage Fund. Negotiators agreed to develop this funding arrangement at COP27 last year to provide financial assistance to vulnerable countries, those experiencing the most severe impacts of climate change, whether it be slow onset or disasters, that fall outside the bounds of adaptation, and they're not covered by current funding arrangements like the Green Climate Fund or the Global Environment Facility. The focus this year will be on how to operationalise this loss and damage fund, and discussions are going to cover, again, sources of finance, who will contribute, and who will be eligible to receive funding. And the third area is reform of the existing financial architecture. These issues are linked to much of what I've already mentioned today, and also, of course, going to be a focus for the upcoming summit for a new global financing pact hosted by President Macron. So, the watchwords I want you to take away from this are urgency, credibility, coherence, and consistency of approaches. And that is what is driving the OECD work to try and help bring some order out of the slightly chaotic world we have out of there. I'm going to end there and thank you again for the opportunity to speak today. I look forward to the panel discussion. Thank you.
Joe, thank you very much indeed for detailing the OECD's approach. It was particularly insightful to have a look at some of the instruments and the standards that you're working to. And of course, your buzzwords there that you left us with were very interesting indeed. You did say something which I thought was interesting, Joe, about the fact that none of this is simple. It's complex. Speaking about green finance investment is not going to be simple. We're going to attempt it nonetheless. So let's begin our second roundtable of today. I can welcome to the stage Patricia Crifo. She's a professor at the École Polytechnique, IP Paris, and Deputy Director of the Centre for Energy for Climate. So Patricia, if you'd like to come up to the stage for us, a warm welcome to you. Wonderful you're here. We have, in addition to Patricia, there's Peter Tankoff, who's a professor of quantitative finance at INSEE Paris, IP Paris. Good to have you with us, Peter. There's Paul Schreiber, senior policy advisor at Reclaim Finance. Peter, if you'll come up for us as well. Pierre-Alex Binet, head of institutional and regulatory affairs at La Banque Postale. Welcome to you, Pierre-Alex. And then we have Virginie Vitiello, who is Head of Socially Responsible Investing with the Caisse de dépôt. So welcome to you as well, Virginie. Okay. Do you want to... All right, so we have a slightly larger panel this time, but less time, in fact. So Patricia, I wonder if we could kick off with you in terms of question. We're unpacking, I should say, the complexities of green finance. Just give us a sense, what exactly is green finance? How does it work?
So basically, most has been already said by Joe, so I would just highlight and build upon this wonderful keynote. So what green finance, climate finance is about is really integrating climate risk into financial decisions. So as has been said, it's a complex process. Climate risk in general in economics is defined by two main dimensions: the physical risk and the transition risk. The physical risk amount to the events, the drought, the flood, and things like that, the increase in the heat temperatures that will affect economic assets. And the transition risk rather come from the policy measure that we have to adopt, the behavioral change that will also perturbate the system and the economic decisions. So it's something complex that also takes a bigger perspective when, as was mentioned by Joe Tyndall, you integrate this analysis and decision within a broader framework of sustainability, meaning environmental but also social and governance decisions. So sustainable finance, green finance is part of sustainable finance, which is a quite complex dimension to evaluate.
I mean, we know it's complex. There are also a number of obstacles which arise ultimately when we want to implement specific green finance projects. Walk us through some of the obstacles that you're bound to meet on your way when you want to, move forward with green financing.
So as main obstacle, I would say there are two big obstacles to my view. The first one relates to the kind of paradox that we are seeing in the form that I mentioned earlier, sustainable finance. This and green finance has developed a lot in the recent past. If we go back to the early 21st century, only at most 10% of the amount of funds that was invested in financial markets incorporated an environmental or social or governance decisions. In 2015, the time of the Paris Agreement, it was up to 20%. And nowadays, it should be around 30% of the money invested on financial markets that would incorporate a kind of sustainability dimension. In France, let's focus a little bit about France, which is considered as a pioneer market for sustainable finance. We would be around 45% of the amount invested on financial markets allocated to green or sustainable funds. So it seems quite popular, but there is a paradox because when you ask people what is green finance, what is sustainable finance, almost nobody knows it. I mean, people, retail investors, they really consider it as an important element, as a crucial dimension. Like 7 out of 10 persons that are surveyed, for instance, by the French Authority for Financial Markets, declare that they really want their banks and their insurance to incorporate such dimensions, but only 20 or 25% of the people surveyed believe in the credibility. It's something that was highlighted by Joe, in the credibility of such decisions. So popularity is a bit paradoxically also an obstacle because there is some doubt and skepticism about such strategies. Is really one euro out of 2 really sustainable? There are some doubts, and greenwashing also is behind that. And the second main obstacle I would highlight is the impact, the notion of impact. Claiming that you integrate an environmental dimension is not a proof that you really have an impact on the climate and that you really change things. So you need to have 3 important aspects to have an impact. You need to have, of course, intention to change and to improve the climate risk, but you also need to prove your impact. So you need really the measurement issue of assessing impact is very important. And you need to have a theory of change that really shows that it's because of your investment that things have changed, that you are not just greenwashing your strategies. And you also need to have strong evaluation and ex post measurement and transparency about that, and that is something we are really lacking, especially when Joe presented the different ESG scores and the correlation between different raters. We see that the correlation is low, meaning that for the same dimension, for the same issue, for the same companies, different raters would provide different scores. So that's also part of the problem.
There's a lot of interesting points there raised about skepticism about the fact that transparency is key, and that sometimes ESG targets are not always matching up to one another. You spoke about investors there. It would be good to get a sense from you, Patricia, about what regulators and investors could do to kind of better include the climate risks into financial issues, because it's not always done to the best possible level, is it?
So I will focus here to answer your question on one specific actor concerned by your question, which are regulators, and in particular central bank. We had the privilege to hear Christine Lagarde a couple of weeks ago talking about the European Central Bank strategy for climate change. And so I think it's important because the need for central banks and for regulators to mobilize finance around and against climate change is really new in the political agenda and in the regulatory agenda. It is something that really comes since the Paris Agreement, so it's something that really matters, because climate change actually is a threat both to economic activity and to financial stability. And the fact that documenting, showing that climate change is a threat to financial stability is something that really is really recent in the agenda. And for instance, if I go back to the French case, in the mandate of the Banque de France, in the report, the yearly report, the governor of the French banking regulations really explicitly address climate change issue, saying that contributing to assessing, reducing, managing the impact of climate in the real economy is really part of the mandate of central banks, which is something quite new. Now, what would be the main tools for that? So not only recognizing climate change as a threat, but also acting is a very big challenge, especially in a time where inflation is rising, which is a core mandate of the central bank. So we really need to consider the different possibilities that a regulator has to address climate change. I would, just for the sake of simplicity, highlight three main things. First, assess the impact of climate change on the economy and on the financial system. And here, central bank and supervisors are really well placed to understand the dynamics of the interaction with financial system, to assess the consequences at a macroeconomic level, and to improve also public knowledge. I've mentioned the popularity of sustainable finance that is sometimes lacking. Second part for regulators is to advise, supporting framework through dialogue, expertise, advocacy, and feed and advise and help also private investors doing, and act. The last part, of course, to address climate change from a supervisory perspective is really to act through macro monetary measures, through monetary policy operation and financial policy measures. So in all the dimensions, in all the actions of a central bank. This is what the European Central Bank is doing. It is also what all the national central banks are really planning to do.
I mean, I'm deliberately kind of accelerating my next question. I'd hope to kind of do it a bit later, but I know that you have to get off, Patricia. I want to think a little bit about, with the number of climate-related issues, disasters, you might say, take in France, for example, in certain parts of the country, we could see the cost of climate-related claims go up, and essentially premiums in relation or off the back of that could rise. How do we remedy that?
So that's a very good point. I will follow you and be brief on that. When it comes to assessing the impact of climate change, what supervisors do is that they do a climate stress test. And so this exercise was done in France. It is done at the European level. It is done in the UK as well. And for the French case that I've witnessed as Vice President of the Sustainable and Climate Commission of the French Prudential Authority of Supervision of Banking and Insurance Sector, what we've seen is that the cost of weather-related events could actually amount to increase by 5 or 6 times between 2020 and 2050, meaning that if those costs of drought, flood, heat waves, and so on in certain departments would to be priced in the premiums of insurers, insurance premiums paid by individuals would rise by 130% in the coming years. So that's really, 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 really huge. It can go from 3 to 7% per year of increase in price. And here we touch a very important aspect, is that once we assess, advise, act, there is also the social acceptability of it. And the social dimension of all those climate-related events are really tremendous. This is what we call the just transition, the fact that we need to take into account both the environment and the climate and its translation into financial decisions, but also the social counterpart of it, and the fact that inequality really raises as the climate change is not addressed. And there are 2 types of inequality to be addressed. The climate risks are not distributed equally, evenly across people. And it's often those people who have the less insurance means, the less capabilities to protect themselves that are hit by such events. So we are really facing a complex issue also as to the balancing between environmental and social decisions and impacts.
This question of equity coming up once again. Patricia, I know you have to leave us. Thank you so much for answering those questions so wholeheartedly for us. Thank you very much for joining us today. I might just swap seats with you, perhaps, Patricia, then, if that's the case, just so I can see the panel and kind of have a look at you while we're speaking. Thanks again for coming in. Peter, if it's okay if we kind of pick up from where we left off, the message that was left with us by Patricia was this question of kind of equity. I want to get a sense from you about the benefits of green finance. Who benefits and how?
Well, green finance is a finance which is there to finance the environmental transition. So who benefits from green finance? Well, to a certain extent, investors. For example, green finance, I think it's important for retail investors who want to go green, who would like to finance the green transition. And so then green finance will allow them to somehow invest to fund the projects that they would like to fund. And then the environment will, to a certain extent, if things are done right, the environment will also benefit from this funding. Then, of course, green finance also involves evaluating climate and maybe biodiversity-related risks. And so from a better understanding of these risks, the whole economy stands to benefit because, as Patricia mentioned, environmental risks, climate-related risks are a threat to economic and financial stability. So if we are able to control these risks, then this means that this will allow us to control, to avoid future financial and economic crisis related to environmental transition, to climate change. So the whole economy also stands to benefit from green finance if it is done correctly. On the other hand, if it is not done correctly, if there is, for example, greenwashing, then green finance can in turn create a crisis of its own.
I mean, greenwashing is a huge issue that I know we'll speak about with our panel. How do we, again, begin to remedy greenwashing? Are there kind of any quick fix solutions to avoiding the capacity to greenwash, or is this just part and parcel of green finance?
Well, there is legislation at the European level that has been prepared to avoid greenwashing, but I think the best way to avoid greenwashing is disclosure, is to improve various disclosure frameworks. For example, at present, disclosure is not compulsory for all companies, so smaller companies do not disclose, for example, their carbon emissions. And also, carbon emissions it is not enough, because we do not only need the current carbon emissions, but we need a way to estimate future carbon emissions, to evaluate the transition perspectives of firms. We need to disclose, as was mentioned in the keynote, the transition plans of the companies. We need to be able to check whether these transition plans are credible, and also to avoid greenwashing. There are tools that can be developed by us as researchers. For example, recently machine learning, artificial intelligence tools have been developed to analyze, for example, company reports, because sometimes the information is there, but it's just difficult to get. And these artificial intelligence tools can enable us to, as one said, weed out the cheap talkers by looking at what they actually disclose. Yes.
So would you say that one of the ways of getting around this greenwashing that you've made reference to and helping financial institutions to best use green investment is one of the ways by reducing the possibility of loopholes? Because there are loopholes that you can get around now by, for example, not declaring certain things. Can we lessen those loopholes?
Yes, and exactly by improving the disclosure frameworks, this can be one of the objectives of this is to reduce the loopholes, because the more information is in the limelight, so to say, the less possibility of using loopholes there will be. Also, the data that is disclosed by the companies should be made publicly available. And there is also an initiative that is in preparation, NZPDU, Net Zero Public Data Utility, whose objective is to make this disclosed data, in particular on carbon emission, publicly available, even for free. Because right now, environmental data is sold by data providers who, for example, estimate or collect carbon emissions reported by companies and then compute some ESG ratings. And there is a big problem in the industry of divergence of these ESG ratings and other indicators. Also, for example, net zero portfolio temperature measures, they diverge among different providers. If you take, this was also I think mentioned in the keynote, if you take several providers, you will have several different numbers and you do not know which ones to trust. Here also regulation is, in my view, necessary in order to make these frameworks more robust.
We've spoken today about inflation and the fact that it's sky high. We've spoken about COVID and also the war in Ukraine. Now, those have all been, I think we all agree, particularly difficult to navigate. Central banks have said that kind of owing to these situations or issues, that the energy transition investments have been put to one side and have been, in some respects, less effective than they might have been. How do we come back from that? And I suppose I'm asking, what are the avenues that we can explore to kind of bring this back to the forefront?
Well, first of all, one of the impacts of the crisis that we have seen, in particular in relation to the war in Ukraine, was the acceleration of some energy transition investments because of the Russian gas is no longer available. And it is important that these investments do not lead to carbon lock-in, for example. If we build new liquefied gas terminals, we must make sure, for example, that they can be used in future for liquid hydrogen. Now, regarding your question specifically on inflation, I think, well, green transition is sometimes said to be inflationary because, of course, you need to raise the carbon price, so this will lead to increased prices of other goods like commodities, for example, metals that you need to construct new wind power plants, for example. But also doing nothing is also inflationary because climate-related catastrophes will lead, for example, to reduced scarcity of food supply, that will also lead to higher prices. Now, what can be done in the present inflationary context? Of course, inflation leads to higher interest rates, so it makes investment more difficult, it's costlier. But, and also renewable energy investments are sometimes considered to be more risky than the traditional investments, so they can be harder hit by this inflation effect. In order to avoid this, I think one needs to work on reducing the risk premium, for example, using blended finance or maybe some public guarantees for these renewable investment projects. This can reduce the risk premium and therefore reduce the cost of investments.
What do you mean, sorry Peter, what do you mean by blended finance? Will you be kind of a bit concrete on that?
It's like public-private partnerships where the state offers some guarantees to private investors to allow them to invest more easily.
So it's more attractive.
Yeah, more attractive. And also another thing that I wanted to add is maybe it's a good time to invest into some energy efficiency projects because of the inflation, energy prices are going up. So this creates, and I see this in Orsay, in my town, this creates an incentive for people to reduce their energy consumption by investing into energy efficiency. And this can also be very, very beneficial.
All right, interesting, Peter. Thank you very much for responding to those questions there. I'd like to kind of stay on this wave and bring Paul in here. This idea that you might mix the financing that you use or essentially, you know, look at other avenues when it comes to exploring green finance measures. Give us a sense, Paul, of an efficient green measure, because it's fair to say when it comes to green finance, there are a variety of ways, as Peter was evoking, that this can be implemented, right?
Oh yes, totally. So I think I would focus on two main and essential characteristics that any good green finance measure should meet to truly be green and contribute to the transition. The first one, and it's probably the most difficult one and the one we don't really see today, is actually tackling the issue of a whole system transition. So what we have seen so far is the development of a class of assets, allegedly green, and I will come back on that point, but we haven't really seen a transformation, a transition, a shift in the global allocation of financial flows. And the problem is, that's what we need. If I can make a comparison, if you look at the development of the energy sector historically, you can see that the new sources of energy have only been added up to the old one. They didn't really replace them, and that's even true for biomass, which is the oldest one we have. It's also true for renewable energy so far. Renewable energy so far hasn't really replaced fossil fuel, it's only adds up to it. And that's what we do with green finance. We finance adding up new, allegedly green things on top of not so green, lots of things. So tackling the whole system transition is definitely the first criteria I would think is essential. Just to give you a few data that could help you figure out how we are today. So since the Paris Agreement, you had the 60 biggest bank in the world that devoted $5.5 trillion to fossil fuels. It was still 668 billion in 2022, so it's still quite a lot.
Just a little, yeah.
And if you look at the ratio for this financial institution, the ratio between renewable energy investment, not only renewable, but what they call clean, so it includes some not so clean things in there, but still clean energy investments to fossil fuel investments. The average ratio for EU institutions today would be about 1.1. So $1.1 spent for every dollar spent on fossil fuels. And the IEA says in 2030 should be 5. So much more. It should even go to 9 if you take into account the investment in demand. So all of the efficiency investment that Peter mentioned. So tackling the whole system transition, we are not there yet. And it's not what most of the green measures you can see are talking about. So that's a big problem that we have. And the second dimension, the second essential characteristic is the one we already started to touch upon with the things like greenwashing. It's just ensuring that what we call green is actually green. And you already have lots of good points made on that issue, notably regarding ESG ratings, for example, which are a great example of that. But you can find lots of other examples. You had green bonds financing coal at one point. You still have green bonds today financing airport expansions. You have sustainability bonds financing new pipelines. So that's basically, I mean, I don't need to explain why it doesn't work.
No, perhaps not.
So any green service, any green products should be actually based on science, and we should ensure that it's truly beneficial to the transition. There is actually a pretty good report from the European supervisory authorities on the concept of greenwashing that was just published. It gives a pretty good and complete definition of the issue. If it was implemented today fully, it would be a big problem for lots of financial institutions. So just a big warning on that, and also some hope that it will be better in the coming year on that specific point.
Do you think, is it realistic to think that green finance will, you know, as you've just outlined there, become really green at some stage without these kind of, you know, afterthoughts and, you know, investments that perhaps don't stand up to what they really should be?
So, is it realistic? That's a good question. I think it could become much greener. That's the first point. Will it be totally green? I don't think so. I don't think it's a proper word that we should use, but I definitely think there is lots of margin for progress. And I can take some concrete examples to exemplify on the points that I'm making. So one good example would be the state of the green bond market. So the green bonds today is probably the most widespread type of green assets that you can find, green bonds. And if you look at the data for S&P Global, you had 775 billion in green bonds in 2022. It's a lot. It's also has to be compared with more than 5 trillion, 5.3 trillion in vanilla bond, in standard bonds, so not green bonds. Also, if you look at the same numbers from CBI, Climate Bond Initiatives, which is supposed to be much more drastic in the way it labels green bonds, the number of green bonds drops to 500 billion. So huge gap between the S&P number and the CBI number. And the CBI number itself, the 500, is not actually what CBI considers aligned with a green definition. It's lower. So my point is, with this example, it's pretty straightforward. First, it's not at all the whole system transition I'm talking about here. It's only a pool of green assets. And second, we don't know if it's actually green, and it seems it's not for a big part of it. So that's the example of the green bond. You can make another example with sustainable funds, looking at the French sector, which is supposed to be leading on that front. You have about 71 billion in sustainable funds in France, without a clear definition of sustainable, just funds that are allegedly sustainable. It's 1.8% of the outstanding amounts for investors in France. If you look at the Greenfield label, this drops to 12 billion. And the Greenfield label, I don't know if you're familiar with it, but you actually have clear criteria on should you invest in such sector. You have criteria to target green investments. You have criteria to exclude fossil fuel. So the number drops to 12 billion. It's just another example that shows that we have a quality question, but we also have a huge volume question. And we need to really have an approach that brings those two together.
So bringing together quality and
I would say quantity, but it's more completeness, the completeness of the approach.
Okay. Quality, completeness. We've been speaking a lot today about the need to either have a top-down approach or a bottom-up approach, that is to get all actors on board. Specifically, we're talking about green finance. What would you say it will take to get your larger financial, regulatory financial institutions on board and your local agencies? Is it complex getting those both on board for the same projects?
I don't think it's that complex. I think it's actually a very top-down process. Today, how it works is the most influential thing we can do is change the rules, the legal rules, also changing the supervision. It has been mentioned several times, but we already have seen in the past, for example, when you have changes in risk regulation, prudential regulation to financial institutions, it can trigger swift changes in the affectation of the allocation of portfolios. So changing the rules, definitely the first step, so it's very top-down. And then also inside the financial institutions, the process remains a bit top-down. So the strategy is usually defined at group level, the sustainable strategy, and then implemented by the various branches. Sometimes the branches, they do have a little room to navigate. They can create their own initiatives. In France, we have the example of branches, for example, in Crédit Mutuel, that set up a specific lending facility for building innovation. So it's a good initiative. But it's an initiative that fits into a global plan that was set up at the group level. So it's always kind of top-down. Yeah.
So I'm hearing from you a cautious optimism. I'm conscious of the time, and I know that there are two students, in fact, that have questions for you, so I don't want to hog all of your time. Pierre, Alex, if I bring you in here, in your opinion, is a bank's principal role, or what is, I should say, a bank's principal role when it comes to energy transition? What would you say?
The business of banks is to allocate capital following the risk appreciation. So in my opinion, the banks have a major role to play in the energy transition. It's a major role to play, and they have to provide capital, service, and also and especially to transform the business model of the other economic players. So for me, it's not easy. It has to be done very strict conditions based on scientific recommendations, and also it means that banks has to exit totally from fossil fuel regarding all the scopes 1, 2, 3, and to provide services, resources, informations, financial informations to all companies to be able to implement their transformation plan as effectively as possible.
I mean, there'll be people listening into you, Pierre, Alex, who think, well, you know, what does the borrower have to do to qualify, if you will, or to be eligible for green finance? You know, that people thinking, well, am I eligible? I've got a project in mind that I'd like financed. What do you have to meet in terms of a borrower to get that investment?
As I understand, there are two parts to your question: the accessibility of all the sustainable products, and also how to qualify our products. So, and also what we do to prevent greenwashing, because you have the accessibility and also the how to qualify. Because greenwashing is a fierce enemy of sustainable finance. We have to, the question of how to qualify our product is a key question. So at La Banque Postale, we have defined very clear and applicable data information to better qualify our offer. We are a mission-led company, so we have one purpose and some environmental and social objectives in our status. So one of our status is to have 80% of our new offers considering as citizen, because La Banque Postale is a citizen bank, by 2025. What does it mean? It means that we have to how to be identified as citizen. We have a ESG checklist. All the new offer has to meet at least 50% of the criteria of this ESG checklist. It's a mandatory tool to...
Why just 50%, Pierre, Alex? Is it because the criteria is so difficult to meet?
Because only 50, because absolutely no products can match all the total criteria, because
not even the best
you have
product
some
in the world?
elements, some characteristics of the element to 50%. It's a big it's a huge threshold to be identified as citizen, because you, for example, you have some very specific, very specific financial tool, and no one tool can match all the criteria.
Does the bank have to meet 50% of the criteria as well? Or
Yes.
do they have to go over that?
We want to have 80%, but for one tool, for one product, for one financial product, it has to match at least 50% to be sure that it's considered as an ESG product with the risk and impact associated to the product. So it's just for the basis. The timeline is the baseline is only to have 80% of our new offer as considered as citizen. But we have also a sustainable, social, and impact products to go even further. And to go back to your question about the green loan, and also the quality, the balance between quality and accessibility. So we have our green loan. It has to meet at least one of the 6 goals of the European taxonomy. Just to say about the regulation, the legal framework, we prefer to have legal framework to qualify our offer, but when the regulation is not as precise as we would like to, it's better to, we are forced to write our own rule, our own doctrine. That's the checklist ESG. So to be green, one product has to meet at least one of the 6 objectives of the European taxonomy, and we therefore allocate the loan to a project defined that complies with taxonomy, but with a minimum of 300,000 euros. That's a very important point, because it's a threshold that is much lower than the market medium average. And so that means that we have a green loan that is accessible and also that complies with taxonomy. So quality and accessibility. To sum up, for us, it's one of our tools to democratize sustainable finance in the territories.
Pierre, Alex, just a quick response for you on this one. In your view, from where you're sitting right now, do you think green loans are as accessible as they could be, or is there still some headway to go?
Green loans are accessible green loans are accessible for those who want to do it. So our role as a bank is to accompany our clients to make it possible. Today, our role to La Banque Postale is to help territories, but also hospitals, also SMEs, and individuals to can have green loans. All our expertise now is concentrate to develop this project on the ground. So for us it's totally accessible compared to the other banks. Of course, we have to do better and to shape it better for a better price to democratize all these tools.
Okay, Pierre-Alex, thank you very much for responding to those questions. Virginie, last but of course not least on our panel, and there'll be some questions from our audience as well. For sustainability, Virginie, to be successful, the environment, social responsibility, I know you're head of social responsibility, plus the economy, they all kind of need consideration. We need to be kind of thinking about those. Can a financial organisation really claim to meet all of those requirements?
Thank you for the question. As Joe Tyndall introduces, there is no clear correlation with ESG criteria and the success of financial. And so we need financial actors that really have a role to play, an active role in transforming the economies by integrating environmental and social issues into the processes. And so at Caisse des Dépôts, as we support public policies and work to promote economic, social and sustainable development, this is a priority for us. For example, we have allocated 31 billion euros dedicated to environmental and energy transition between 2020 and 2021. And so at Caisse des Dépôts, we are both a public development bank, where Banque des Territoires and BPI France mission is to finance and develop businesses to make the region more sustainable, more connective and more inclusive. And also we are an asset manager where we manage French people's savings. We buy equities, corporate bonds and sovereign bonds that meet also ESG criteria. And so to have a robust ESG and investment criteria, we have developed an investment charter since 2014 that has been updated last year, where we have like 3 pillars: ESG integration, stakeholder dialogue, and exclusion. And so we have reinforced this year the exclusion list and also the stakeholder dialogues, and it will be applicable for all of our activities in July this year. Also, for example, we have developed internal tools. It's to make the decision, investment decision now. Every important, I would say, material investment need to be screened through this tool since this year, so that we have the same level of, criteria between ESG and finance. So this is really new also. I need to point out the regulation. The Article 29 of the French law on energy and climate laws is also getting a level up because financial institution needs to be transparent and on biodiversity, climate, and ESG risk. And need to report this year all of those. And so I'm sure you will see a difference between last year's report and today's report in every financial institution, because you need to be more transparent. You need to communicate not only the good data, but also the bad data, I would say, like the brown exposure. And this is a really important shift I can see. But of course, to high up ESG at the same level of finance, sometimes you need to have a lower return on investment. I mean, if you want to make an impact, you need to, for example, we have seen some projects in wastewater management or waste management or heating network that are projects we finance, but that are important for the territories, but with lower returns.
I mean, you spoke about, what did you say? You said that ultimately we need to report the bad data as well as the good data, which is fair, and you touched on, Virginie, this idea of transparency. I guess my question is, how do we kind of reduce the temptation to kind of greenwash? How do we get financial institutions away from wanting to just show, as you said, the good data, but not the bad stuff? Your thoughts on that, Virginie?
Mm-hmm. So I think we need to go back a little bit from the history of ESG, and I think it's really started in 2015 with the Paris Agreement, and at that time a lot of communication were made and saying you need to report, and you need to say that you are green, you need to show off, and but it's not. I don't think I've seen this. I've seen this move. I've seen also competencies inside financial institution to strengthen, and now I can see that, for example, we cannot communicate our commitment result without being very precise on the scope, for example. We need also to be rigorous and transparent on the different flows. And we cannot only communicate on what we do well, we must also report on all of our activities to account our exposure to brown sectors. And that's also the recommendation from ESMA. And I can give you also the example of the SRI label that has been some controversy. And for that, I think we need to go back to the definition of greenwashing. Okay, greenwashing, because it's a label, it's not a greenwashing label. And the greenwashing terms refer to the act of communicating action in favor of the energy transition that have not been kept or carried out. And for example, if a fund manager announced wrongly that it did not finance fossil fuel, the SRI label does, however, lend additional credibility to responsible investment. So I think also there is a need to better address transparency and definition to what is greenwashing.
Okay, so better address transparency. The deeper we dig, the more things we realise we need to regulate, right, Virginie? I'm just conscious of the time. I'd like to, at this stage, thank you all for answering those questions. I'd like to welcome on stage Ekaterina Gauche and also Lena Monas. They are students of the Institut Polytechnique de Paris and the École de Pont. Welcome to you, ladies. Don't forget, these are the questions that you've been feeding through to us. So, you know, we're making this an interactive conference. Again, this is an open kind of floor, so do feel free, you know, if you do want to answer the question, it's up to you. If we start with you, Ekaterina, what would you say is the first question that you have?
Sure, actually, sorry to disrupt maybe your order, but maybe I'll hand over the first one for Lena, if that's all right.
By all means, by all
Great,
means.
thank you. So she'll kick it off.
Okay.
Go ahead,
great.
Lena.
So thank you. First of all, thank you all for this very interesting panel. And my question had to do with, in your view, whether financial institutions saw green finance rather as a constraint today or rather as an opportunity. And what were your thoughts on that? Thank you very much.
Right, so I don't know who would like to respond to that on the panel. Did you all hear the question okay, or should we repeat it? We didn't, maybe, Lena, if you just read it again a bit louder for us.
Oh, sure.
Thank
Sorry.
you.
So my question was whether today green finance was seen by financial institutions as rather a constraint or rather an opportunity.
Peter, do you want to respond to that?
This question is better addressed to professionals,
Okay.
right?
All right, fine.
Because it's
Either Paul or Pierre-Alix?
Yes, sure.
Go ahead.
For me, it's both. Sorry, but I can't arbitrate. But for me, it's a constraint. Why? Because we have more regulations, we have more efforts to report, to make it more consistent, and also now we live a very fierce competition in the ESG markets. And in the reverse, it's an opportunity. Why? Because we have a lot of very new markets emerging, and now we have the deep depths to in our area of investments to have a better structured, to have bigger projects to finance. So. Because banks, investors want projects to finance. Now we have the supply calls to bigger projects, and it's an opportunity for financial players.
Okay, so you say a bit of both, a bit of a pain, but equally there's some room for opportunity there.
Because it's getting mainstream, and when something becomes mainstream, you have both the drawbacks and the advantage.
Okay, interesting.
For the society as a whole, it's clearly an opportunity to do something to save the planet, so to say, right?
Of course.
It gives us, maybe it will enable us to attract sufficient private capital to finance the energy transition.
Okay, interesting. The next question then from Ekaterina.
Sure. All right, so this one will be a bit more zoomed in, and I'll ask it in two parts, if that's all right. So the background is considering the many EU reporting requirements coming into force aimed at standardizing and facilitating climate-related disclosure to not just be a burden for these regulated entities, but ultimately help investors make informed decisions, such as the Sustainable Finance Disclosure Regulation or the Corporate Sustainability Reporting Directive, or even zooming in on green financial products, as I believe Paul brought up, green bonds. There's a EU green bond standard. My first question is, are corporates and financial institutions empowered to accurately report? What are their pain points, and what can be done to address them? And the follow-up to that is, how will regulators verify disclosures are indeed quality and therefore meaningful to public and private stakeholders alike? Thank you.
Anybody on the floor want to take that question? Or the first part at all?
I didn't catch everything.
Yeah,
Sorry.
perhaps if we just read it again, just the first part we'll go with, Ekaterina, just so we make sure everyone's kind of got the first part of the question.
Do you want me to repeat it?
Please.
Sure. So are corporates and financial market players empowered to accurately report on these disclosure requirements? What are their pain points, and what could be done to address them?
I don't know whether Virginie or
I can start.
you want to go ahead? Go ahead.
Yeah. So about the disclosure regulation first, so of course you had a big gap between the EU perspective and the non-EU perspective. On one side, CSRD, Corporate Sustainability Reporting Directive, which is yet to be translated into the technical regulation, which is called ESRS, so we will see what's in there. It's not yet published. And on the other side, the ISSB work, which is an international body working on a voluntary standard, which is much less ambitious than the European one and much narrower in the way it addresses climate. So you can remember basically that ISSB on one end is very much about financial materiality. Does it have an impact on me financially? And the EU tries to look at this dimension, but also as the potential impact I have with my activity on the environment and climate. So looking only at the EU one, because the other one I think is, the definition itself shows it's not sufficient to fully take into account climate change. It's progress still, but it's only about financial risk, so it's limited progress. About the EU one, it's a regulation that is based on a comply or explain logic. So you have to report on it. You can also report that you don't report and justify why. It's also a regulation that contains lots of good indicators, potentially including on the transition plan aligned with a 1.5 targets. But I can totally report that I'm not aligned with the 1.5 target. The regulation itself doesn't mandate me to be aligned. It's just a benchmark kind of for reporting. So it's definitely very good progress. Lots of good information for investors to go find in there, but also not enough when it comes to actually aligning the activities with the goals of the Paris Agreement. And the final impact of this disclosure regulation will depend on other types of regulations. For example, we have a discussion today at the European level around corporate due diligence. And in the corporate due diligence regulation, you have an article about transition plan. If such article would be in the final text, you would have a much stronger requirement to actually have aligning transition plan adopted by companies that fall under the scope of due diligence. It's only one example. You can put that in several regulations, also on the prudential side, so more related to financial risk. You can give more weight to your disclosure regulation.
Okay, thank you very much.
Just to comment quickly on the second part of the question, how to check the accuracy of these disclosures. I think for this we need public databases that, for example, researchers, people like us, can scrutinize and detect some irregularities, or maybe compare this data to data obtained from other sources like satellite data, machine learning, and then this can be also shown to check whether there is something wrong with this or this data set.
All right.
And maybe one comment?
Yes, go ahead.
Sorry, just very shortly. On CSRD and the extra financial reporting, it's essential, it's key to implement all the strategy of sustainable finance in Europe. So it's a shame that it's adopted only at the end. After we have to disclose, we have to define and to disclose something on an information we don't have because CSRD has not been adopted yet. And also it's a shame that we are still in the discussion on the granularity and the ambition of all the indicators. I think now it's done. We have all the indicators. We have a level in ambition. We have to go. We have to move forward, and we are still in the debate on what would be better for this indicator. And of course, it entails a lower ambition at the end. So that's my two adding elements to the discussion.
So the debate goes on, the debate continues. I'd like to say thank you to Ekaterina and to Lina for coming up and sharing those questions. Thank you very much indeed, ladies, for doing so. Also a big thank you to our panel, so to Peter, to Paul, also to Pierre-Alex, and of course to Virginie. I asked the people at the end of our round table to give us kind of this major takeaway. Just a few words, on the overriding message that you want us to take away today. It can't be long. It's cheating if it's long. It's just a few words. Okay. What would your overriding message be, Peter? What do you think?
Well, there are several messages, but maybe the short one is okay. We discussed green finance and sustainable finance, but it's important to remember that finance cannot be green without being sustainable.
Oh, I like that one. Okay, can't be green without being sustainable. Excellent, Peter. Thank you, Paul.
I would say basically stop developing fossil fuels.
Okay, so very straight to the point. It will solve a lot of problems. Pierre-Alix?
Thank you. Like that, I can have more time to.
You've gained 2 words there.
2 words. No, banks are on the middle of the road, and because banks are better equipped and maybe highly regulated, so we can move very fast, and that's my last word.
So give banks more time, is that what you're saying? We need more time?
No, we need to go fast, to go faster.
Okay, so let's speed things up. Okay, thank you, Pierre-Alix. And Virginie?
So 2 words, I would say engagement, to have a strong engagement from the top of the company or the financial institution, and transparency.
Okay, strong engagement and transparency. On that note, that brings us to the end of our second roundtable. Thanks again. Thank you. All right, so you heard it there. One thing is clear, the real need for sustainable finance, but it's anything but simple. You open one door, another is opened, and more criteria needs to be met to ensure that it's sustainable and really green.